Okay. Let's see if it works on YouTube. Kai, we might have to push the YouTube link. I'll do it on my end. I'll share it with you, and everyone can have it on their social media. Okay, so we are streaming on YouTube. I'm gonna share the link so everyone can have it. Let's see. Okay, Kai, I think we're live. We can get started.
Okay. We'll start the way that we start every single session with a land acknowledgement. A land acknowledgement recognizes both the indigenous communities as the traditional stewards of the land and also the relationships that they hold with their lands, which sheds light on issues of colonization, displacement, forced assimilation, health disparities, and disproportionate incarceration rates that we witness. We remember and connect with shared experiences in order to build solidarity and to disrupt all oppressive systems. We want to thank the indigenous peoples whose ancestral and unceded lands we are occupying for this space to share our knowledge here. We see the Canarsie, the Rockaway, the Merricks, the Massapequas, the Mentoncox, the Nantucket, the Manhasset, the Erie, the Mohawk, the Mohican, the Oneida, the Onondaga, the Seneca, and the Tuscarora, among other communities we call to remember. We usually begin each of our sessions with the Brave Spacing Agreements, which you see here highlighted on the screen. This is just to symbolize that we're here in a space that we hold together with consensus around the values that we share. And from here we can build on knowledge and build on political frameworks together. So with that, I'm going to have pass this back to Assemblymember Ron Kim.
Thank you, Kai, and thank you for co-hosting our town hall on tax justice. Kai Zhang is our executive director of the APA task force. Just a couple of housekeeping. We had originally announced that we will be live streaming on a Facebook link. However, Facebook is not cooperating with us, so we have a YouTube link that we've shared with everyone on the chat. We were live streaming on YouTube, and if you can share that link on other social media outlets so everyone can look in, that'd be great. Thank you. So thank you, DSA, Debt and Finance Working Group, for co-hosting tonight's event. So let me kick it off with a couple of comments, and then we're going to try to go right into the main part of the town hall. And we'll also be joined, hopefully, by one of our colleagues. State Assembly Member Charles Barron is expected to join and share a few words as well. So as of today, the federal government won't bail out New York, and the Federal Reserve has former muni bond traders running their new lending facilities, trying their best to keep cities and states away from seeking public money. Even though I believe the federal deficit spending and public borrowing are the clearest and immediate way to plug in the gaps of our budgets and our social needs, we must diversify our efforts and seek permanent revenue streams by taxing the rich. But by relying solely on the revenues generated by extreme wealth, we could further validate the need for extreme and concentrated wealth so rich people could come to our rescue. And consequently, instead of focusing on how to end wealth inequality, we may focus on the right tax rates that extract maximum revenue out of the rich while keeping them motivated enough to continue making more money. But this vicious cycle of tax and money making doesn't add up, and it's not sustainable. The rich gets richer by extracting value and wealth from the bottom of the marketplace. They do this by leveraging their private money, lending interest-bearing loans, and all sorts of legalized put options to protect their big stack against the smaller stacks in the marketplace. So we may recirculate some of the wealth back to working and poor families through a fair and progressive tax rate on the rich, but through private or through private philanthropy. But as long as the rich are motivated to make more money by exploiting the poor, our people's wealth will continue to trickle up. For now, and today, we don't have a choice but to participate in this rigged system and fight for safeguards for the poor and working families, such as new financial instruments and asset building tools. For example, we worked with DSA Debt and Finance on our proposal, the Inclusive Value Ledger, also known as the public Venmo, which would allow unbanked constituents to tap into their public benefits as convertible and portable new money, just like how the rich create new capital assets to hide their wealth every day. I was born in 1979, the year that started the conservative revolution and untaxed and unregulated capital growth for the rich. For every minute I've been living, corporate lawyers and financial intermediaries have worked nonstop to codify new financial instruments and assets that make capital as portable and universal as possible for the rich. All this means is that the ultra rich are almost 100% resilient to economic downturns and recessions. The rich, the ultra rich, they didn't gain their wealth in the last 40 years because they're smarter or more talented than the rest of us. They were simply able to hack the system so their capital gains are untaxed and generates profits through subsidies, or simply put, corporate looting. I believe that's why we need to start reframing the discussion around taxation. We must tax the rich to break up the concentration of wealth, which is the root cause of our failing social conditions. We tax the rich to reset our social contract with working and poor people, setting the new terms to permanently end wealth inequality. We tax the rich to make monopolies unprofitable. We tax the rich to set up public takeovers of for-profit energy, broadband, and real estate corporations. We tax the rich to reestablish public sovereignty with community land trust, worker cooperatives, and a public sector that can serve the public again. I believe the 6 proposals that DSA Debt and Finance have thoughtfully put together is the beginning of this process that could generate a minimum of $50 billion of new revenue for our state and leapfrog us, our state, into ending wealth inequality. These 6 bills are also the gold standard for ensuring New York, the leading financial capital of the world, focus on the core problems behind tax injustice, capital gains, regressive tax rates, lack of a real wealth tax, and corporate tax dodging. With that, I look forward to our town hall. I look forward to the presentation, and I'm going to turn it back to Kai to continue this meeting. Thank you all.
So I think we have a presentation led by Jenny, and I think the slides are with you, Jenny, right?
Yes.
Okay.
Let me
Okay.
share my screen. Am I sharing my whole screen or am I just sharing the window? Sorry. Okay. Awesome. And I will kick it off to John to introduce our working group and what we do.
Hi, everyone, and Thank you very much, Assemblymember Ron Kim. So my name is John Parskevopoulos, and I'm here today with several members of the New York City Democratic Socialists of America Debt and Finance Working Group. New York City DSA is a chapter of the Democratic Socialists of America, an organization of volunteers committed to an equitable distribution of resources, popular control of economic planning, feminism, racial equality, and liberation from all forms of oppression. Our working group specifically works on issues related to debt and finance and ways to create an economy in New York where our collective prosperity can be shared by all and not just a few, in many of the ways that Assemblymember Ron Kim was just speaking about. And actually, before we start, we wanted to pass the mic quickly to some of our friends from New York Communities for Change who are here and who are able to talk about some of the things they're seeing in terms of demands for more revenue in New York City. And so with that, actually, Alicia or Jose, if you're able to talk.
Hi, sorry, I was having a hard time getting off the mute for a second. I'm Jose Gonzalez with New York Communities for Change, as John was saying. I'm a director of data and research, and our organization fights for social and economic justice. We work in communities of color in all 5 boroughs and Long Island, and in coalition with other groups like DSA, we started the Make Billionaires Pay campaign because we understood that our efforts to bring economic justice to our members meant budget and taxation justice. So we've been fighting on this issue for a bit, over a year, I think, and Alicia has more to say on how we're working with our members.
Yeah, thanks, Jose, and thank you so much for having us, Jenny, and the rest of the Debt and Finance team, and Assemblymember Ron Kim. So if NYCC, we're pretty well known for our campaigns, and we can often get a little bit militant with our approach to getting social justice for our members. So we've been, as part of the Make Billionaires Pay campaign, we've been going after a number of billionaires pretty forcefully. This included, over the summer, going to the Hamptons, to the homes of billionaires who have been profiting from our communities, doing the kind of things that the Assembly member just mentioned. And also, one of the things that we wanted to talk about is kind of the evolution of our membership base and the fact that revenue is a core part of every single one of our campaigns, right? Whether it's housing outside of cancel rent, but the need for affordable housing that entails revenue. We're part of the Excluded Workers campaign, and a lot of our efforts are connected to a wealth tax, so we can fund people who have been, provide relief for those who have been excluded from federal aid. Our education campaigns, we're leading the campaign for fully free and funded CUNY as well. So getting our members around this idea that the cause for social justice is intrinsically linked to budget justice, and which is fundamentally at the core of it, it's been kind of part of this evolution, and they're increasingly calling for these bigger revenue raisers, and they're very much connected and kind of hitting the streets in demanding this. So Jose, I don't know if there are other things that you want to mention, but we are doing some popular education workshops with our members as well. We just did an internal one with our staff around why billionaires shouldn't exist. And we're transferring that over to our membership to really build this, the class consciousness and the fact that everything is fundamentally linked to our unjust tax system and budget justice. Jose, I don't know if you want to chime or if we're good. He says he can't get off mute.
Okay, sorry. Yeah, so I think that's right. I think that the idea is initially our membership wasn't, the idea of taxes and stuff like that can be complicated, and sometimes it's difficult to also communicate the importance of it. But I think slowly over time, they've really gotten to understand how intertwined it is with all of our campaigns. And I think in terms of the evolution of our membership base at this point, they're very much on board, and they very much understand the fact that it's imperative that we do something about the taxation system. I think that's all I wanted to add.
John, back to you.
Thank you. Thank you both. We wanted to, before I get to the rest, we get to the rest of the presentation, I just wanted to talk a little bit about, what the stakes are here and why this is so important, and how dire the situation really is. In life, we encounter a lot of difficult questions, some of which have been pondered since the beginning of time, like why do some folks get so frustrated by pineapple on pizza, or why does nobody love me, or why in a society as prosperous as the United States, in a city as wealthy as New York City, are so many people struggling to get by. We're here to talk about the unprecedented levels of inequality that we see in the communities around us, that causes so many to live lives of quiet desperation, coupled with levels of social immobility that we haven't seen since the 19th century, that makes it impossible to live a better life no matter how hard you work. Just to kick things off, we have a poll. How much wealth do you think the top 1% of Americans own? And keep in mind while you're answering this question, how much wealth you might have in your bank account. The options are A, 24 billion, B, 500 billion, C, 34 trillion, or D, $510 trillion. And I can't see the results. So billions is the right answer. I've seen the chat. Jenny or Assemblyman Ron Kim, do you want to mention what the poll results are?
Yeah, so we have 66% of people have voted. If you haven't voted yet, please try to click a button on your screen. So the winning, with 50% of the vote, 8 people voting for this, the winning answer is 34 trillion. And you guys must follow inequality a lot because that is the correct answer here. So the top 1% of people have a combined net worth of 34.2 trillion. These numbers, at the scale, like what does it even mean? But to kind of put it into context, this is 8 times the size of the entire federal budget. So all the programs that we know that come from the federal government, Medicare, Medicaid, housing vouchers, our defense spending, which is out of control, take all of that, times that by 8, and you have the wealth of the top 1%. Cool.
Thank you, which is truly unconscionable. The fact of the matter is levels of inequality right now are greater than they were in the 1920s. More and more families in America and in New York are struggling to get by. Good jobs are hard to come by. I'm sure many of you have noticed the average rent for a 2-bedroom apartment in New York City annually is $43,000 a year. In Queens, it's $32,000 a year. If you're making $20 an hour full time, that is about 2 people making that amount. That's 50% of their annual wages they'll be spending on rent. And forget about it if you work a minimum wage job part-time, which so many of us do. Meanwhile, the average pay for someone in the top 1% in New York is $2.2 million per year. And Jenny, if you can take us to slide 6. We also have to remember that inequality in New York and in the United States right now is extremely racialized. The median and average Black household wealth is about 1/10 of white household wealth in the United States, and the trend is only getting worse. And in a society like ours, where political power is tied to economic power, this racialized inequality works to disenfranchise working class people and communities of color, because the political process is becoming increasingly dominated by the ultra wealthy. Meanwhile, coronavirus has only exacerbated these inequalities. Billionaires have added hundreds of billions of dollars to their wealth. Just here in New York, since the start of the pandemic, while 1 million New Yorkers statewide are out of work, while our neighborhood businesses are being forced to close, and while hundreds of thousands of families in New York are struggling to put food on the table. And so tonight we want to talk about what we can do about this. I'm going to pass it off to some of my friends in the Debt and Finance Working Group, Nathan, Crystal, Ofer, Boris, and Jenny, who are going to talk about how we got here, what the situation is like in New York, what our budget is like, and what we can do to make New York an economy that works for everybody and not just a few. Thank you so much. And with that, I'm going to pass it to Nathan.
All right, so thanks everyone for coming. We're going to discuss a little bit how we got here and just what these sort of recent historical trends are in terms of the economy as a whole and in terms of the policy decisions that have been made that brought us to this point. What's going on? As a theme, keep in mind that inequality is not inevitable. That's the underlying policy message. So we have another poll for you. What's the biggest cause of inequality?
Tough one. They all sound really bad.
I don't know when the results come in or if that appears on my screen.
It's a toss-up right now. People are still making up their minds.
There is actually just one right answer.
All right, so 71% of you guys have voted, and with 40% of the vote, people think that the biggest cause of inequality is the financial sector has distorted everything, from housing to higher education. We want to tell you that actually the correct answer is all of the above. So Nathan was lying, I'm sorry. It is both political and economic forces that drive inequality, and we will get into that a little bit later. They feed upon each other, but with political institutions, we have an opportunity to kind of try to temper these economic forces, and we'll show you exactly what decisions have been made that have made things worse for everybody. Since the 1970s, governments at all levels have pursued policy changes that have accelerated these trends and worsened inequality.
So it's actually kind of a nice answer that so many people picked finance because it's obviously a very big part of the story. This may be a familiar graph, but it's essentially just the overall productivity of the economy against wages. It's become a sort of pretty, common thing to say now accurately that wages have stagnated. And that's really been the case for about 50 years. But it's not because the economy has stopped growing. That's the divergence that you see in this graph. So, of course, the question is, what's going on if most people's wages aren't going up, but the economy continues to grow? Well, all the returns are really going to the wealthy. So this shows you that the top 1% has really captured so much of economic growth since 1980. This is the sort of period that we think of as the beginning of neoliberalism, Reagan Revolution, tax cuts, attacks on unions. That's the high level story. But a big part of it is the rise of the financial. Was really not a huge part of the economy until it was heavily deregulated in the late 70s. And so this chart is consistent with what we just talked about in terms of the top 1% capturing so much of economic growth. The line that rises very steeply here shows finance, insurance, and real estate. So those are all highly speculative industries. You hear about land bubbles, you heard about the obviously the mortgage bubble in the great financial crisis. Insurance is another kind of financial product that's part of the same game. And then obviously just finance very broadly has developed a lot of new instruments, a lot of new trading strategies that have caused very significant returns to financial businesses without really benefiting anybody else at all. Now, not only do they capture all the returns, but it's a very unstable form of growth. Typically, financial growth depends on a boom and bust cycle where speculators can get in, get big gains, and then get out. Some of them gain, some of them lose, but overall, the sort of financial sector is profiting while everybody else ends up paying the price in a few different forms. Right? One can be the loss of asset values, like where people lost their homes in the financial crisis and they were foreclosed on. But of course, the other is just the government ends up bearing the losses because these crises tend to be very systematic crises. They affect everything. And so the government has to intervene in order to somehow stop the crisis. Otherwise, you have a total economic catastrophe. This is a relatively familiar story after the great financial crisis, which was kind of the most extreme version of it. But it's not like that was the first time it happened. There's a very frequent history of recurring financial crises, actually throughout the whole history of capitalism, but especially going back to this period where deregulation began in the late 70s and early 80s in the name of permitting financial innovation, but really ended up fueling these boom and bust cycles. So part of the story is financialization. Another familiar part of the story is globalization. And they actually both sort of have the same origin in terms of deregulation, in the sense that globalization really means the free flow of capital across borders. So sometimes we think of that as offshoring, has a few other consequences, but basically it's the ability of capital to move freely across borders. And that's obviously what has enabled many American businesses and many other multinational businesses to locate their productive activities, their manufacturing centers, in very low-cost jurisdictions. It raises their profits. There are also regulatory benefits because often those places will just have weaker environmental protections and other forms of regulation. But the biggest benefit here is that this is essentially a union-busting strategy. You can avoid unionized labor. And it's important to keep that in mind because we talk a lot about the decline of manufacturing, but the reason that those are good jobs is because they're union jobs. You know, in the early 19th century, manufacturing jobs were not good jobs. They're very, very miserable jobs. It's only when they became unionized that those became high-wage jobs. So the loss of manufacturing as a sector, and this shows you the dramatic decline in the manufacturing sector, really means it's a loss of union labor, and of organized jobs that pay a living wage and have job security and good benefits. And with that, we have another poll.
All right, I guess I'll lead us through the poll question. The question here is, what did the economy look like from 1945 to 1973? And for folks streaming on YouTube, the options are A, pay rose with productivity; B, workers at all levels experienced income gains; C, the Gilded Era's concentrated wealth was redistributed through public policy; and D, household indebtedness was low and kept pace with household income. So what did the economy look like at mid-century?
We have 52% of people voted. Give it another few seconds. It was also a tough one. All right, 73% of you voted. And the answer that you guys thought was most accurate is that workers at all levels experience income gains.
But in actuality, we know that this is another one of those trick questions. The answer is all of the above. Let's take a look at the next slide and walk you through some of the reasons why our economy at mid-century is so different than the economy we have today. So as Nathan reminds us, inequality is not inevitable. From the 1940s to the 1970s, benefits of economic growth were shared across earning spectrums. And that's what you can see on this chart here. you'll see that in that sort of that period we call the Great Prosperity, the share of incomes that the top 1% was taking home was relatively small. The lowest income earners at this time increased their incomes at a faster rate than the wealthy did. That's remarkable, and that's certainly not what we see today after we've entered this period that we call the Great Regression from the 1970s to the present. Let's look at the next slide. So one of the large drivers of this, our entry into the Great Regression, is the decimation of unions. So the chart here shows that there's an inverse association between union membership and inequality. As union membership decreases, inequality increases. That's not only because collective bargaining can raise wages, it's also because unions themselves are a countervailing force. Unions benefit all workers, not just their members. Collective bargaining essentially sets broader standards that non-unionized workplaces must meet. When we're losing unions, we're losing that countervailing force. Next slide. So union decline is middle class decline. Here we're seeing an association between union membership decreasing and middle class wages eroding. And the antecedents to this moment are the trends that we talked about a bit earlier: globalization, deregulation, the rise of precarious work. And lastly, I'll share that inequality is not colorblind. Collective bargaining can be powerful for groups that experience discrimination, folks like women, people of color. Collective bargaining creates fair processes, it raises wages, it closes pay gaps. There is a 2012 study, a counterfactual analysis, that found that among women, the Black-white weekly wage gap would be between 13 to 30% lower if union representation remained at that high 1940 to 1970s level. If we saw that same great prosperity level of union membership, women would have much higher wages, Black women in particular, and Black men's weekly earnings would be at least $50 more than they are, now each week. So inequality is not colorblind, austerity is not colorblind. These trends that we're tracing in our presentation are having disproportionate impacts on people of color. And now I'll pass it off to Jenny.
Awesome, thank you, Crystal. So in addition to, union busting policies at the federal, the state level, right to work laws, Taft-Hartley Act, tax policy is another big area of economic policy where it actually exacerbated trends that were caused by global economic forces. So I was really proud of myself because I managed to embed a video into this presentation. And what this video is kind of showing is effective tax rates by income tier. On the right, you have the very wealthy. On the left, you have the poorest in society. And over time, what's happening is that your tax rates on the very wealthy are coming down dramatically. This happened from the 50s through to today, to the point where we are in this dire situation today, where the tax rates that the wealthy pay are actually lower than the tax rates that everyone else pays. So I think what this chart is very symbolic and emblematic of is the fact that the wealthy have gotten wealthier, but they've used their wealth to acquire political power. Change like this doesn't just happen unless you actually have control over our political systems. So these things are intertwined. They're reacting based off of each other. This is just a chart that shows kind of tax cuts over time and who has benefited from these tax cuts. So as you can see, it is by far the richest 20%. Reagan came and lowered marginal tax rates from 70% to 38.5%, a very, very aggressive cut over a short period of time. We'll get to this a little bit later, but we're going to be talking about ways that we can combat inequality and raise revenue for the state in the legislative session next year. But I think when we're talking about ideas like that, it's important to keep in mind that over the course of history, other actors have been unafraid to make dramatic, huge moves like this. We should not negotiate against ourselves. We should not hold ourselves back. It is time to be brave. It is time to ask for the most that we can have, because that's what's happened over the past 50 years. The other side has been unafraid. So This is another chart showing just household debt exploding over this period that we've been talking about since 1975. If you combine, tax cuts for the wealthy with stagnating middle class wages because of financialization, because of globalization, because of the decline of union membership, what ends up happening is that people have to turn to debt to survive. So that's why we're in this place where we have to get debt to have housing, we have to have debt to get educated, we have to have debt to pay our medical bills. You have to peep under the hood. This is not something you see on the streets, but this chart, I think, says a lot, and this is how we've managed to get by. It's not an ideal scenario for the vast majority of the working class. And with that, one last thing I'll say is that New York is no exception to these trends that we're talking about mostly at the national level. If you look at New York's economy, the 1940s to the 1970s looked very different from the 1970s to today. You can see this in this chart that shows how much of income gains were captured by the 1% versus everybody else. It's two completely different pictures. This can start to give us clues as to how we fix this problem and where we go to from here. And with that, I will turn it over to Ofer, I believe.
Hello, sorry, I just, there was an issue with the muting, but thanks, Jenny. Will you go to the next slide? So we're gonna start with a poll. This is kind of here, we've been talking about like these high level changes in the United States. And here we're going to talk a little bit about more specifically like what life in New York is like and has been affected by these things. So the question here is, let's say you are a male worker earning around $50,000 in these days. Like this data is from 2014, but essentially it's the same today. How much would you have earned if you were this person in 1973? The question here is basically, there's been essentially 40 years of economic growth or 50 years of economic growth. So you would expect to see that in higher wages. So how much would, someone just like the literally average middle worker make? 4 choices. It could be all of the above. But it might not be.
So for the people watching on YouTube, the choices are $100K, $53,000, $44,000, or $28,000.
Like you'd expect them to have earned less in the 70s. Like, would have gotten a raise essentially.
Okay, so 62% of you guys have voted, and by far the most popular choice is $44,000. Unfortunately, I'm going to tell you that no, it was actually choice B, $53,000. Essentially, the median worker has not experienced income growth over the last 40 years.
Yeah, there's been like a slight decline. So basically, if you're making, I'll actually get more to that in a second. But there's been there's been massive economic growth, but no income growth for like the average workers. So one piece of context here that's specific to New York is lots of times, so right now we're in this basically a fiscal crisis. The most common reference point that you hear is the crisis in the 1970s in New York, where there was like a big economic crisis. Now we've been sort of the reason that happened nationally and in New York was essentially a result of the sort of decades of like social changes, labor market changes, policy changes that led to this kind of cycle of together. There was like a massive decline in manufacturing that led to union power kind of falling apart. All that was aided by government policy. There was also kind of like explicit government policy to facilitate a white flight to the suburbs. which essentially starved inner cities of resources because the tax base left. And all of that over the course of a few decades led to a situation where in the 1970s, there was like a massive fiscal crisis, which then, and sort of like a destroyed city, basically, or like cityscape, specifically in New York and other cities as well. So the lesson, sadly, that a lot of people draw from this is, oh, today we're also in a fiscal crisis. Therefore, we must not repeat the mistakes of the past. We have to make sure that we're very like fiscally responsible and we don't spend money and we keep our budgets tight. And the reality is that's the exact wrong lesson to take from the 70s. Like what happened, what's actually happened, what's happening today, like what's the kind of actual economic situation that New York is in today is that we've had 50 years. So there hasn't been like a decline in manufacturing over the last 50 years. And there has been, but that's not like the cause of the crisis today. And also there hasn't been like a flight away from New York. In fact, in both those cases, very different things have happened. First, there's like a massive finance industry has developed in New York, which is the single biggest industry in New York and is a third of the entire GDP of New York is just finance. That's an industry that barely existed in the 70s in the way it does now. The second thing that's happened is there's a total reversal of the flight to the suburbs and populations in the city are massively increasing. So if you want to essentially, if you want to replicate the crisis of the 70s, what you would do is starve the government of money, cut social services, and then you would get a situation like that. So going to the next slide. This is now just like the sort of like more like the nitty gritty of what's happened over the last 50 years in terms of wage growth. So if you look at the kind of chart below there, you see, this is like, you see the median, you see the income levels for different classes in society and how they've changed from the 70s to 2018. And then the last column is the counterfactual of what the income would have been had growth been distributed equally as it had been before the 70s. So as an example, the median income in 1979 is $60,000. So like anyone on this call that makes $60,000 in the same, in 1979, if growth had been distributed equally, you would today be making $125,000. So that's like what your salary would look like today. If I didn't explain that in the smoothest way, but the bottom line is, if your salary today is $60,000 and what it should be today is $120,000, and that's what it would be had growth been distributed equally. Instead, the only like salaries that have increased at all are people in the top 10%. Their salaries have doubled, but then people in the top 5, and especially the top 1%, their salaries have gone up like an extraordinary amount. So then the question is like, well, what do we do? Or, and the reason the simplest solution is in a sense to change the tax code is because there's a lot of room to tax the wealthy people. So this chart shows how much of a tax burden each class in New York pays. So basically, you see that, and the ideal tax system is a progressive tax system where the more money you have, the greater tax burden, the greater is your tax burden. So in this case, what you see is that the top 1%, basically people that make $800,000 a year or more, they literally have the lowest tax burden of anyone in New York State. And then the top 5%, people that make over $250,000 a year or more, their tax burden is also relatively very, very low. The people that have the highest tax burden are basically people that make between $30,000 and $100,000 a year. It's essentially like the entire middle class of New York. So this is, I mean, it's basically what this is saying is like, this is where the action is. It's like, we need tax policy to fix this situation.
And before we jump into the next section, I want to welcome Assemblymember Charles Barron, who has just joined us. We are in the middle of describing the current situation of inequality, what has led us here, and kind of what we can do about it. We're about to go into the what we can do about it section, but I don't know if you wanted to maybe give some remarks, or if Kai, you have.
Well, first of all, I want to thank Assemblymember Ron Kim for this. I think we always need to focus on the budget. I think that's where we can tell where people are really progressive or not, is how we handle the budget. And I think it's unconscionable, unheard of, that we pass a budget with no revenue package to go along with it. So I think that as we finish this, there are some obvious revenue generators that can happen right now, and some can happen in January. And I don't know why people are waiting to see what Trump is going to do or not. It is unconscionable, unacceptable. Ron and I have been fighting this thing for the longest. So Ron, I want to congratulate you and thank you for this session. And, you know, I'll be with you on any legislation. And I came here to learn and to voice my opinion. And have a stock transfer tax immediately. Take it all. Don't rebate it back. And they won't leave.
Yes, you'll love what we have to say next, which is we should do that plus so much more.
Oh, but you got that right.
Yes, okay. So I'm gonna reshare my screen. And we're about to get into the actual exciting part of all of this. I believe Crystal is taking this section.
All right, everyone. So we have another poll question. This one's going to help us think through our current budget situation. So who has the largest GDP? Is it New York, Sweden, Russia, Canada, or Denmark? Whose GDP is largest?
All right, we still have some votes trickling in. I think this
voted for
is easy
Denmark.
for people. Someone said Denmark. People are not. I would have said Russia, but seem to be the odd one out here. Okay, so with 76% of people voted, New York is coming out at number one with 80% of the vote.
And folks are right. New York's GDP is $1.7 trillion each year, compared to the Scandinavian countries that are known for robust social provision. We have Sweden at 556 billion, Norway at 434 billion, and Denmark at 355 billion. New York exceeds them all, yet does less for its most vulnerable populations. All right, so our current economic situation, even before this triple pandemic of health, racial, and economic injustice, we are in the midst of a budget crisis. NYCHA has a $40 billion capital backlog, that's a billion with a B, leaving residents in undignified conditions, broken elevators, mold, mildew, vermin. The MTA had a $60 billion capital backlog, which means that commuters are often frustrated with delays and breakdowns. Unfortunately, instead of seeking the revenue we need to stay afloat, our leaders were considering austerity measures. In this past budget cycle, just a few months ago, Mayor de Blasio was looking through the school's budget to identify $500 million in cuts. We know that schools, housing, and transit are essential to the vibrancy of our city, and each requires predictable long-term funding. Our current budget at the state level is not providing that. Take a look at the next slide. So New York can do so much more. As the poll question illuminated, New York is an incredibly wealthy state. Our GDP trumps that of independent nations, including nations that are known for a tightly woven safety net. The graphic here depicts the nation's wealthiest metro areas. And of course, the New York metro comes on top. We're over there in the top right-hand side of the graphic. New York is the nation's wealthiest metro area, meaning that our GDP is a sizable portion of the United States economy overall. We contribute a large portion of the nation's total economic output. Let's look at the next slide. So this is a chart that is showing the ratio of tax revenue to GDP. And this is a metric that can help us understand how much of a jurisdiction's economic output is collected in taxes. So here we're comparing the total size of the pie, or economic output, to the slice of the pie, the taxation that the government is taking and redistributing for the good of everyone. You'll see here in the United States that our federal government controls a relatively small share of our national economic output. So we have to think about this slide and the previous slide in tandem. We know the New York Metro generates a lot of economic output, but given the paucity of our federal taxation system, as shown in this slide, we're not getting a lot in return. If we want to ensure that New Yorkers get what they deserve, affordable housing, high quality schools, reliable transit, good healthcare, we have to raise that revenue in-house. We need to look at our state budget and see what we can do.
Cool. So we're about to head into a section, what can be done? I think it's James or Boris.
No, it's James, and then we'll alternate the proposals.
All right.
And I'll conclude.
Gotcha. So we're going to talk a bit about what we believe. So New York's economy is enormous. Like, this is comparable to an economy you would find even in Europe. We can afford much, much more than we're currently providing. Our tax system funnels almost all of New York's economic growth to the upper class. And we can actually make a few structural changes and add somewhere between 50 to 75 billion every year to our state's budget. So our basic platform is to tax high incomes, tax wealth, and tax big business. Yes. So we're pushing for 6 basic bills. So one on income tax, one on capital gains tax, a constitutional amendment to allow wealth tax, an inheritance tax, financial transaction tax, and a corporate tax. And the corporate tax is going to be responsible to the changes at the federal corporate tax structure that was changed with the Tax Cuts and Jobs Act. And this should raise somewhere in the realm of 50 to 75 billion per year if all of these solutions are implemented. So this is what we have. So first thing we want to focus on is the income tax. So these are the current rates and brackets. You can see that you're seeing like a gradual increase in the income tax rate, and then this increase gets smaller and smaller as you go up to higher income brackets, and then it just caps at 8.82% for people making around over $1 million a year, or around 2 million over or 8.82% for making around $2 million per year as a married couple. We think we can do better than this current system. So these are the marginal tax rates we have. So the blue line, that's what our current system looks like. Ideally, we want something more of like what the red line is, like a gradual increase of taxation as you're increasing further income. Like, that would be a truly progressive rate.
Yeah. So along with the income tax rates, which most folks should be familiar with, since if you work and you make income, you pay at the city, at the state, at the federal level. But along with taxing high incomes comes taxing something called capital gains. For those that don't know, capital gains is the profit you make basically when you sell stuff such as stocks or bonds or derivatives, other financial investments. It's basically investment income. So any income that comes out of you investing in these stocks, you make gains out of them. And right now at the federal level, people pay much lower taxes on their capital gains, right, on investment income than on your ordinary income taxes, which is what up the proposal that James said that we're trying to also go hard and aggressive on. But we want to go aggressive on investment income as well, especially since proportional or in relation to income to your income taxes that you pay, you're paying very less levels. So this only benefits the richest and wealthiest people in our society. And New York should increase its taxes on capital gains to offset the difference between income or investment income and regular income. And so this next slide actually shows who benefits from capital gains. And I want to start with from figure 2 before heading to figure 1. So you get to see that the bottom 80% of households, only 6% of those folks benefit from capital gains, whereas the top 0.1%, 47% of the households makes up who benefits from those, and then 20% of the rest of the households make up 47% as well of the pie of who invests or who rather benefits from capital gains. And then figure 1 is also another form of showing that as well. So that proposals 1 and 2 cover our 2 proposals of the category of investing high incomes.
All right, Bill 3, we're talking about going more after wealth itself. So New York already has a sort of wealth tax. It's called the property tax. Like if you own a house, you have to pay a certain tax based on the value of that property. The current New York State Constitution does not allow taxes on quote unquote intangible property like stock portfolios, art collections, only real property like homes. So that means the middle class homeowners have to pay a tax on almost all of their wealth, because if you're middle class, all of your wealth is invested in this real property in your house. Well, rich people, they only pay a fraction of their wealth because most of their wealth is it's not just their property, it's their stock portfolios and other things, which is considered intangible property, which can't be taxed. So we want to amend the Constitution to allow for a real wealth tax so that the wealthy people in this state, they will pay the same kind of amount of taxes that a middle class homeowner is paying right now.
Yeah. So we have several more slides to go. We'll make it to bill proposal 6 and then conclude from there and open up for a wider discussion Q&A portion. But bill number 6 or proposal 6 is an inheritance tax. And currently we have something called an estate tax. And that applies when a person has passed away. And therefore it's often called a death tax because of it. An estate tax has certain exemptions in the state of New York. It only starts for estates over 5.85 million, right? So for those that want to go more aggressive, you'll say why. And that's exactly where we're going to get to our proposal here. But the current system sets that exemption for estates below 5.85 million. The top rate is only 16% for 10.1 million, right? So if you pass away, leave an estate of that's worth 10.1 million or above, you're only going to get taxed 16% of that. So right now the current system is that estate tax, and very key to mentioning here, because this is a huge difference from the current system as to the one that we want to propose with an inheritance tax, is that the estate tax only applies when a New York resident passes away, not when a New York resident receives an inheritance. And we believe that way you can tax more if you are taxing a wider pool or a base of folks that are receiving the inheritance versus passing away. So our proposal is to eliminate that estate tax altogether. Just don't worry about and make these carve outs and just replace it altogether with an inheritance tax on New Yorkers that receives an inheritance and that give inheritance. And we're going to attach that to all inheritances, right? And create a progressive structure where we're taxing progressively the more you get as an inheritance. So that's our 4th proposal.
All right. So our 5th proposal is a financial transaction tax. So like if you know anything about New York, the thing that first comes to your mind is Wall Street. The financial sector is by far the largest in New York, and it's grown massively since the 1970s. And you can see different aspects of the New York's GDP, with financial activities taking up about a third of all of New York's GDP. Hong Kong and London have financial transaction taxes as well. So this isn't some untested theory. This has worked in other countries. And this would be a small tax on all financial transactions, stocks, bonds, derivatives, etc.
And last but not least is the corporate tax. So in 2017, Trump's big tax reform reduced corporate income taxes from 35% to 21% at the federal level. And we're proposing to reverse these changes by creating surcharges at the state level. Also key to mention is Cuomo during his first term also decreased corporate taxes at the state level. I do want to say, almost closing out here, but before we get to the last closeout slide, that some of these proposals exist out there as bills. Assembly Member Barron mentioned the stock transfer tax, difference between the financial transaction taxes that is more comprehensive and take into consideration all financial instruments, right? And also what exists is the income tax rates. There's different proposals on ultra millionaires. We want to make sure that ours, or the one that we want to favor or that folks push for, is a super aggressive one that speaks to super progressivity, as that graph pointed out to. And to close out, so we're in a crisis, and it's not just because of a pandemic, right? We were in this crisis before, as the entire historical context provided by our crew pointed out. We need huge structural change to the tax system, the tax code. And, the political wings have shifted. There's been huge electoral victories on the left. And we think that altogether, these 6 proposals, common sense proposals, can be ones that pass next session. It's sound, simple platform that clearly discusses changes and problems to our tax structure, and it would raise at least $50 billion. And for that reason, right, for all these myriads of reasons, our economy is super strong. We're wealthy. We live in an abundant state, bigger than the GDP, the gross domestic products of other countries that have huge, strong safety nets, right? And yet we're not sucking enough resources to uplift people, especially during a time of need. And so therefore, you're gonna be hearing a lot about these bills or proposals, them being drafted technically into legal language, it being pushed along with and creating more noise than the measures that are being put forth now. And we also believe in voting no unless you're really, really raising revenue to the degree of $50 billion for the state of New York. That's what we're talking about, to really right the wrongs of history. And that's what we're going to be fighting for come next term. And really, really, really want to just say thank you to the Assembly Member Kim for opening this door and this town hall for us. So thanks. And we'll leave it up for open questions and comments from everyone.
Kai, you want to?
Yeah, I guess I have a question. In the lineup where you have the GDP for several countries against New York State, I was wondering if you have the same data for GDP per capita. I know New York City has like 8.5 million, and the state has like almost 20 million in population. I wonder how that weighs against the population of like a country like Sweden, and what the actual average wealth is per person in comparison to New York.
Yeah, Nathan, do you want to take this one? Oh, I think he needs to be unmuted.
Yeah. That's a great question. So it's New York's GDP is actually higher than all those countries listed on both a net basis and a per capita basis. So that's the really sort of surprising thing compared to the most sophisticated welfare states. Is even on a per person basis, New York is still actually wealthier.
To Baron? Hold on, let me unmute.
Good. Can you hear me now?
Yes.
A couple of things. One, every time we talk to the speaker and others, and we talk about these kinds of taxes, they say, well, even if you do a wealth tax, if you do a millionaire's tax or a progressive tax, we're not getting that money to January. So, no sense in fussing about that now. So I want to know how many of these proposals can we get right now? I think the stock transfer tax or the expanded version that you have, which I think is a good idea. How many of these taxes can we get right now if we convened, let's say, and they probably won't convene until after the election, and we said, well, let's pass something right now so we don't have to hear that line that he's waiting for the feds to give something in January. That's number one. Number two, could you comb through the budget for us and probably in a future presentation? Because I believe there's also a prioritization of spending that needs to be looked at. That money which is out, what is it, 178, Kim, 175? Whatever the budget is, if we comb through that budget and see how much do they give subsidies, to these developers, I know that's a huge amount of money, and how many bonds and all of this stuff that they provide, because they always crying broke. I find it hard to believe with $178 billion that you broke. It's there may be deficits, of course, but it's the prioritization of spending. So I think if we coupled with this package of taxation and say, as we're doing this, we could actually do better if we transfer some of the money you're already spending on those who have more than enough to deal with, that we can really close some gaps and also help some of the more needy people in the state.
Yeah, well, those are, of course, excellent questions. Just first on the timing issue, that is just one of the constraints of raising income taxes, that it can take time to bring the money in. Given the projected budget shortfall and that the state expects it to continue into the future, and that even this year's budget gaps will have effects for subsequent years, in some cases, that's just the best we can do. One strategy would be to use some of those anticipated tax revenues to support current debt financing of some of that shortfall, but then you wouldn't worry about the debt causing a crisis because you would have appropriately raised taxes in order to be able to pay off the debt. It's great to focus on the FTT because you're right that that's not an individual income tax, so you don't have to wait until people file their returns or have some sort of withholding. So yeah, and that's supposed to be a big revenue raiser. That's one reason why we expanded it to cover everything. So that's right on. In terms of the second question, that's.
Can I just respond to the first, Kim? Yeah. I just want to respond real quick. See, even that financial piece that we're talking about, what is the number? I heard 6 billion, I heard 13 billion, because I believe the tax already exists for the stock transfer tax. For the life of me, I don't understand the 100% rebate back to Wall Street. But what is the number, and how immediate could that tax be implemented, executed?
I think our revenue estimate is around 16 billion for the modest tax on all financial instruments. I think, to what you said earlier, I think that there would obviously be a little bit of time involved administratively just in getting it set up. But legally speaking, I don't think there would be any serious reason to delay imposing the tax. You know, people are going to say, "Oh, this will take forever to adjust to, so you have to give us 5 years to figure out how to do it." But you know, that's just, I think, a political battle.
Right. What about the argument of the stock market? They'll leave, they'll go somewhere else, they'll do it online, all that other stuff, but they're already doing stuff online. But
yeah, so the tax that we propose actually is imposed in a few different ways. So one is that it's imposed on New York residents, individuals and businesses entering into those deals. So it wouldn't be enough to say sort of trade stocks on the Chicago exchange instead of the New York exchange. You'd have to leave the state. And they're always threatening to leave the state, but you know, they stay here even though taxes are like, they can't move their businesses just anywhere they want to go.
Like that, yeah.
Yeah. And then even the exchanges, actually, there was a really nice reporter. We should circulate this article, but a reporter got in touch with us and she did this really in-depth study of this proposed, both the sort of stock transfer tax change and a broader financial tax, financial transfer tax. And she got some really good people on record saying, basically, you know, these exchanges are like huge institutions with a lot of physical infrastructure and a lot of employees. It's not that easy for them to just move anywhere in the country. That's actually very costly. And so, you know, they would basically do a calculation, say, oh, is it worth it? And given the costs, it's definitely not clear that they're going to leave.
Right.
Especially because the tax isn't on them. You know, it's the people doing the deals.
Exactly.
Over the exchanges.
Exactly. You know, that was my point. And I did talk to the people at Ways and Means, and they were saying it was 6 billion. I heard 13 billion, and now you're saying 6. Your 16 billion is beyond the stock transfer tax and some of the other financial.
Yeah, James and Jenny, did I get it right? What's our
yeah, so it's hard to estimate revenue. I think most revenue estimates are not super accurate, but the stock transfer tax does have a range. It's like counter-cyclical, so it raises more in downturn years because there's more trading, there's more volatility. The financial transactions tax that we are proposing has that similar feature. But just because you are going for a much broader range of financial instruments, you have the ability to more than double what tax on stocks would raise in and of itself. So we're in the range of like between 15 to 25, wow. But it's a lot of money, and that's because, you know, the financial sector is so huge here in New York State. It'd be silly not to impose something like that.
Yeah. And what's the rationale for the 100% rebate?
That's just a bad historical legacy, you know. Okay. The rebate, they kept on increasing the rebates, really cutting down the tax, and then they phased in the full rebate in about 1981. So it was just part of, you know, the sort of beginning of the bad times, basically, in terms of policy.
So I don't hog up the time, if you could answer the second question, and I do have to run for another web meeting, and I appreciate you allowing me to ask the questions.
No, thanks. Those are all, I mean, wonderful questions. Exactly what we talk about. We haven't, so there are definitely huge subsidies to business in the state, and as spending goes, a lot of those credits, I think in ordinary times can't be justified, but especially in crisis times, they can't be justified. Still, it's actually not something we focused on, partly just because we want the sort of biggest revenue raisers possible that will like really bring in enough money to fix the crisis. And a lot of those credits are like should be cut, but there are sort of, you know, there are like current constituencies that'll get very upset if you talk about cutting them. You start a big political battle and you're talking about a few $100 million here, a few $100 million there. And given the timing and the magnitude of the crisis, we thought, well, let's just sort of go all out on the biggest changes that would bring in the most money possible.
Right.
Yeah.
Well, Charles, sorry.
Sorry. Just wanted to quickly chime in. You know, definitely believe though that cutting the spending that's really neoliberal and those price tags
Right.
on
That's
things
right.
like 421A, right,
That's you go.
are a must, right? And it's right. People say what to do about the budget situation. There's three choices: you borrow, cut spending, or you raise revenue, right? We believe this is the revenue piece. We believe in the cutting spending, right? Some folks will say, no, don't cut spending. I'm like, yeah, don't cut spending to our social services, but cut spending to those corporate,
That's right.
entities
That's
that are
right.
benefiting from it. So we definitely believe that conversation should be had as well to have the biggest overarching comprehensive tactical strategy possible. But yeah, and there's others to look at, but those raise political fights, right? With 421A, that's real estate, film tax credit. You got the film industry, ICAP in the industrial and commercial abatement program, manufacturing, so on and so forth. But yeah.
Yeah, so Charles, we talked about this issue before with corporate tax credits last year, and we've looked at anywhere between $4 to $6 billion of corporate giveaways in New York State as a whole. New York City, between $2 to $3 billion. And there's a good website, Good Jobs First, has, if you just put in any state, they keep track of all the local and state corporate subsidies around the country. So we know exactly where these dollars are going. And in places like New York, upstate New York, we're literally spending $1.2 to $1.5 million a job in Buffalo Billion and Elon Musk's, dream, spaceship, whatever he's building in upstate New York. So we definitely think that's part of the larger package, the discussion. And we'll keep at it. But tonight's, as Boris was saying, tonight's focus is.
Because I remember, Ron, you did a good job raising that about the subsidies, and I saw some of your stuff on TV and everything. You were awesome on that issue. Because that, if we combine that, but right now, the tax is the thing that we probably can get a better argument for. And lastly, before I leave, I'd appreciate it if you could send me this presentation. I would really appreciate it.
Well, we're hoping you may pick up a couple of bills as well, Mr. Barron.
Oh, you know that. I'm with you.
Okay.
I'll prime sponsor or co-sponsor with my man. Either way, you got me.
Thank you, Mr. Barron.
All right.
I know
Miriam has a question, I believe.
Yeah. Who's up? Dave?
Actually, I think not now. I'll go to a meeting and talk to you about it another time.
Okay.
Miriam had a question? Okay. Okay. Well, just piggyback off Charles, just very briefly, in terms of going after these corporations and also capital gains, like, we also read about like the enforcement aspect, as people transferring their regular income to capital assets to dodge paying taxes, because that's where the incentives are. But that's actually clearly a violation. Like, you can't knowingly transfer assets to avoid paying taxes. You're breaking the federal law. So I think some folks might be curious, like, how much of this is about enforcement as well as taxation? Anyone?
All right. So I think that enforcement actually seems to be a bigger issue at the federal level. It's sort of a point of interest, really, but the IRS has huge enforcement issues. And that's because of systematic defunding over decades. And that's what you call the tax gap, right? The gap between what the tax revenues should be and what they actually are. I don't know what it is for New York. I think it's not huge. I would also say that for the stuff we've proposed, maybe aside from the FTT, which would be a new tax, most of the taxes are already on the books. And so there is not very much, if you want to avoid income tax, you basically have to commit tax fraud. And there are a lot of people who are willing to hire tax lawyers to use fancy strategies to exploit sophisticated gaps in rules, but there are many fewer people who are actually willing to commit fraud. So that's a benefit of just changing the rates or modifying taxes that exist. And so in that sense, even though you would need audit capacity, we don't think it would actually pose significant enforcement challenges.
And Nathan, while I have you there, what about the motivational I'm just playing devil's advocate of all the people. Well, if you tax Wall Street too much, they won't just leave. They'll stop performing. Why would they want to make money? Why would they want to, trade stocks if you reach a point where it's no longer profitable for them? The same thing for the ultra wealthy. Why are they motivated to make money if we reach a point where they calculate, well, it's not worth it anymore. Why I'm not making enough money?
Well, I'm glad you said it, because we never talk about that, but it is one of the most common counter arguments. It's just sort of, like you said, it sounds like something that comes from the right. And I think we have two answers. One is that obviously they're completely out of their minds, and they'll go to any lengths to make another buck. And also just realistically as a proportion, I mean, even if we raise the rates to what we're suggesting, and they're pretty aggressive proposals, they're still making just unbelievable amounts of money. But I think the second argument actually goes to exactly what you said at the beginning of this event, which is, what's it doing for the rest of us? I mean, if they stop working, it doesn't really hurt anyone else. That only hurts people if they're really creating jobs and if the gains from all their economic activity are being distributed. If they're just getting richer, why, we don't care if the taxes make them, trade a little bit less at their hedge funds.
Mr. Barron?
What about the pied-à-terre tax, the tax on those second homes of the wealthy folk? I know they were saying we can get 600 to 800 million with the pied-à-terre tax. Is that still something that's going to be on the table?
I'm happy to keep talking, but I feel like
Ofer has a good answer on this one.
Ofer?
Oh, I think we're all muted, so Nathan has to be the only I think the thinking about for this platform is that there's things like the pied-à-terre tax and also the yacht tax and other taxes that are designed almost just to, it's they're designed in a way to be able to say that, hey, we have taxed the super rich, or we've taxed billionaires, because the pied-à-terre tax, it applies to second homes worth more than $5 million or something. Right. And it doesn't actually, I mean, $500 million is a lot, but right. It's really changed compared to right. the actual budget needs we have. And we really, really want to avoid a situation where something like the pied-à-terre tax gets passed, and then Cuomo gets to say, yes, we've done it. Right. The rich. Right. So for this package, we wanted every single item to be
multi-billion.
Massive on its own. So there isn't sort of as much potential for compromise. And also we wanted each item to be about taxes and revenues. So something like the pied-à-terre tax, fundamentally, it's not actually a problem with the tax code. It has to do with what your kind of theory of how housing should be used and how housing should be taxed, and whether you want to discourage certain kinds of housing. And in a similar way, it's almost similar to something like certain tax credits. Fundamentally, those are tax credits like the film credit or something that are part of an economic development policy. So we think those things should definitely change. It makes sense to increase taxes on properties of very wealthy people, but that should be part of a housing policy or a housing platform. It should be kind of argued about in those terms.
Gotcha.
But if you kind of bring that into a tax package, then you're introducing kind of debates in a sense that don't have anything to do with the fundamental question of we need more money for the budget and we need to change the tax code.
Right.
But then, if you start talking about kind of let's say economic development policy, then it's kind of well, we need the film tax credit because it helps this industry. And now you're sort of talking about an entirely different subject.
Makes good sense. Thank you for that answer. And I do have to say good night and thank you all very much. Appreciate this.
Thank you, Charles. I think we got maybe about 5 more minutes. Alfred, would you also agree that consumption tax in general is one of the most regressive forms of taxes around? So if we are going to after the yachts, doesn't it make sense we also address the structural overall, the entire consumption tax structure at whole, instead of just picking on a couple of items at the top?
Oh yeah, I feel like I mean, Nathan can speak more probably to that. I know he likes talking about consumption taxes, but but it's a little bit like, yeah, like focusing on the yachts as a way to address, I mean, because it's like, that's sort of, I feel like the right way to think about it, which is that the base is, goods that are consumed. So if you want to if you're going to try to raise revenue, it doesn't make that much sense to do it by targeting, this micro portion of goods. It makes a lot more sense to, you want it to apply just much more broadly, basically.
Right.
So it's like in a similar way with the income tax, it's like, yes, you could raise income on only people that make exactly $100 million a year, and you will raise money off those, whatever, 85 people, but it makes much more sense just to raise, to apply it to the whole.
Including luxury services, right? I don't think billionaires pay any legal fees when they hire their lawyers, right? Or their corporate lawyers, or financial intermediaries. They don't pay any services for hiring them either, right?
Now you're really on our wavelength. That's not even part of this proposal, but it's definitely one of the most regressive features of the overall tax policy. So, consumption taxes are basically sales taxes, but it's called a consumption tax because the economic activity that's being taxed is the consumption of goods. So if you eat food, if you pay to see a movie, that's the value you're getting out of that is called consumption value. But the things that are really taxed under that kind of scheme are basically just goods. There are a few services. They tend to be like nail salons and massage services. That's it. There are just a few in New York. And because working people spend most of their money just sort of buying stuff because there's not a lot left over to save, they end up massively disproportionately bearing the burden of those kinds of taxes. Whereas the wealthy people who can save up a lot of money are bearing a much, much smaller burden. So it's definitely a regressive tax. But the way to blow it open would be to tax services, which are really consumed by people who are well off. That's a whole other frontier, though. But it's the right way to go.
Okay. Maybe we can wrap up. My girls are knocking on the door. I'm consuming their room right now, so I'm trying to get in to go to sleep. So thank you so much, DSA Debt and Finance, and our allies, Kai, Executive Director, and the entire team for this. This is the beginning. I think Charles, showed up. Thank you for Charles Barron. He just heard about it. He felt passionate about wanting to be part of this. And I think we will get other members to organically pay attention, and we will reach a point where all these things will be normal language for all of us in Open Albany. You want to say some closing remarks, Jenny or Kai?
Yeah. Ron, you have been such a leader on these issues from the very beginning. We are super glad to work with you. The respect, we have a lot of respect for you. We hope it's mutual. But yeah, I think going into the next legislative session, it is an opportunity. It is a crisis and an opportunity like no other. It's kind of now or never. If there's ever been an environment for making our tax code just and raising a large amount of revenue, this is going to be it. So we are super grateful to you for wanting to lead this fight. It's not going to be easy. There's a lot of organization that will need to be done, but we're feeling optimistic after tonight, and just thank you for your interest and your leadership on these issues.
Thank you. Okay, maybe we'll take a quick picture, symbolic picture before we go. Hold on. Wait, James is getting his hair ready. All right, I'm gonna take a quick snapshot on my 3. 1, 2, 3. All right. Thank you. All right, have a good night, everybody. Thank